I've organised a great opportunity today to speak with an independent financial advisor and actually hear from the horse's mouth about what we should all probably be doing in the way of pensions, protection policies. What about those pension pots from the past that we haven't really had a look at? Why should we work with someone like this, a professional? So I've brought in today someone who I've worked with for quite a number of years, a guy called John Longford. John works for a firm called Northern Spire, which is a St. James's Place wealth management practice. St. James's Place, FTSE 100 company. They're very, very good at what they do. And John has been looking after, dozens of my clients for quite a number of years now. Just making sure that they've got the right stuff in place, they're making pension contributions for the future. But let's hear from John, and I'll let John introduce himself. So thanks so much for joining us, John.
So thanks for having us. I suppose kind of the bread and butter of what I do on a daily basis, got a client bank that is the majority of sole traders or limited company directors, and we do three main things on a daily basis. One is pensions, so putting a pension in place for somebody who doesn't have one. Consolidation of older pensions. So if you believe kind of what you read, we'll have 8 to 10 jobs in our lifetimes if we're employed. So in today's climate, that means as you move jobs, you leave little pension pots scattered around all over the place. Standard investments, money sitting in the bank that is not earmarked to be spent. That gets eroded by inflation. So the best way I can describe that, it rots away because we don't get the same interest in a bank as we do kind of the inflation going up. So we can invest that for you. And then a range of insurances from a personal point of view. So kind of protecting against the likes of your mortgage or your income. And then some specially designed insurances for company owners that can run through the company, things like death in service or, again, kind of that income protection, just to make sure that what you've got is protected for you and your family in the future.
Okay, brilliant. I mean, it sounds really great. I mean, I think business owners are particularly bad at paying attention to this sort of stuff, like consolidation, all of these little pots of pension. Just to pull that point is, why is it important? Why work with you as opposed to just trying to do this sort of stuff yourself?
Yeah, so kind of, I wouldn't say they're bad, but what I would say, I'll put it in a nicer way. You don't know what you don't know. So the best way I can describe it is I'm good at what I do. However, if I work with, say, an engineering firm, they will have a wealth of knowledge of things that I haven't got a clue. I was previously employed by a big corporate company and I had everything put in place for me. And I walked in and says, John, there's your pension. And if you die, here's a death in service, your family will get a payout. When I had a child, my boss says kind of actually that payout grows, it doubles because you've now got a child. They did everything from offering me child care vouchers through me, salary sacrifice, offers to kind of buy shares in the company at a reduced price. Everything was put on a plate for me. If you are running your own business, whether it be a sole trader or limited company, you are good at what you do, but you're normally kind of king or queen of the castle. You maybe haven't got the people kind of in your ear discussing all the other things that isn't part of your day-to-day role. And that's the bit where I come in and kind of say, well, have you thought about tomorrow? Have you thought about protecting yourself? Have you thought about protecting your family? What will happen when you sell your company? How are you going to pay a wage in future when the company isn't running? Various different things. And I'll go back to that phrase I said at the start, you don't know what you don't know. So people might not think they need help, but all of a sudden kind of quite simple questions from me becomes quite a revolutionary kind of moment of awareness for people where they think, actually, kind of this things I'm not aware of, and maybe they need a bit of help tying those loose ends up.
Okay. And just to talk a little bit more about pensions, we're obviously a great referrer of clients across to you because we see them as a tax planning tool, don't we?
Yeah.
I think that's possibly the wrong way of thinking about it. And you have to take a longer term approach with clients. In terms of your life, you need to start early. Is that the best approach or not?
Yeah, so kind of, I suppose there's the black and white way. So essentially, the earlier you can start and the more you can put in, the more grateful you will be down the line, the happier that you've done it. All a pension is you shuffling your money from one place to another. The government really want you to do it, so they'll kind of give you tax benefits on there. And the more money you've got in there at an early age, the longer it's got to be invested, the more you will have when you come to retire. So it's as simple as that. But I'm also kind of, from a black and white financial advisor point of view, I'm not naive to the fact that we've all got lifestyles that we want to live as well. So when we're 18, we want to go out and kind of, we're probably on a smaller wage. We've got other things that we want to do. Go out at the weekend, kind of buy your car, go on holiday. It might kind of meet the new boyfriend, girlfriend, whatever it is. The likelihood is we haven't got excess money to put away into a pension pot that will be deferred for when you retire. That's not the thing that's on your mind. So if I can just say, kind of, a pension pot is essentially, it is your wage or your job for when you don't go to work anymore. So Monday morning, you're sitting there, don't have to go to work. You still want a wage coming in. That is what you're building your pension up to be, and that's what it's for. That's the traditional sense. But going back to what you said, Justin, around tax benefits, I've had a conversation just in the last few days where I've said, well, this is what traditionally a pension's for, it's your wage, but right now for you, it's a really fantastic vehicle for you to pull money out of your limited company in this case and put it into your estate. It's bringing your tax bill down, but it's a way of you paying yourself more. The only caveat that is they're deferring it for a few years until they do retire. But yeah, there's a mixture of everything in there. But yeah, kind of, to put it really simply, it's your wage for when you do retire.
I mean, one of the things I'm often encouraging clients to do is, I see an opportunity where someone hasn't built a pension at all, and I can think of one mutual client that I've referred over to you. You know, he's got a butcher shop, shall we say, and you know, he's starting a pension up late, and I'm saying, well, let's start a monthly contribution going all of the time. Whereas I've got other clients who just want to kind of look at the tax benefit and put a lump sum in. That has its advantages and disadvantages, doesn't it? So what's the advantage of putting a monthly steady amount into your pension versus like one chunk every, say, 12 months?
So there's a bit of mentality in there, and there's a bit of market action. I'll explain both. I do like a mix of both. So I like clients to put in a modest to a medium amount that they feel comfortable with on a monthly basis, purely because that becomes part of your outgoings. A bit like when you pay your mortgage for the first time you buy a new house, it feels like it's a big outgoing. 2 or 3 months down the line, when it becomes part of your kind of your daily outgoings, all of a sudden, kind of, it's just something that happens. And that can be the same thing for a pension, whether it be £500 a month or £1,000 a month out of your business. You might look and think that's a hefty amount of money. If that becomes part of your operating kind of turnover, then all of a sudden, kind of, you don't feel the effects of it anymore. The truth is, those two examples, you've got £6,000 or £12,000 at the end of the year that's in the pension. What it also allows you to do is, towards the end of the year, do a bit of tax planning with your fantastic accountant and sit down and say, listen, what's the liabilities going to be? Is there a way I can reduce that tax bill? And that's the bit where you can top that regular amount up with lump sums. Between the two, a conversation I've had today, I would definitely say it's harder if somebody's going to give me £10,000 a year into a pension. It's a lot harder at the end of the year to say, John, there's £10,000, because it feels like you're giving a lot of money away, rather than say, John, there's £500 a month, and then at the end of the year, there's an additional £400. It's exactly the same, but there's a mentality in the way it makes you feel. So that's why I like a mix of the both. Again, my first review I had today, clients who've been with us for a year, 2022 wasn't a fantastic year for investments. Across the board, doesn't matter who you're invested with, there's been a lot of things going on in the world. Those 3 gentlemen who are part of the company are at a net position of 0 in their pensions, even though for the vast majority of 2022, investments were going down. That was a benefit of pound cost averaging, because they were putting in on a monthly basis, and as investments were going down, they were buying more units of that investment. So when it comes back up, they have actually got more to grow with. So they were buying in for value. So even in a time when investments haven't been a fantastic time, for clients who are meeting and they've been putting in regular regular payments on a monthly basis, it's actually been some positive news for them, because as long as those investments come up before the point of retirement, then they are better off. So even in times when markets aren't great, you're still getting value. So that's one of the benefits of regular payments in as well.
So that's quite interesting, that pound averaging, obviously as the market is going up and down, you're hitting some of the peaks and some of the troughs, and it's basically meaning that you're in a good position. So yes, that's very interesting. So obviously pensions, great vehicle. We're creating that job for when we don't go to work. I love that analogy. I think that's really great. I think some really important stuff, that pound cost averaging. We've got tax planning in there. This is all kind of great stuff. So I think some of the objections that I get from people is I'm too young to pay into a pension. How would you quickly just not answer that one?
I wish I was in a position where I could put money into a pension, and I was in a position to say I was too young, because you will be grateful in future if you are in a position where you can put money in. You feel as if you're too young, because you will get the benefit of compound interest over the years. Yes, I'm fully aware that you've got money that you've got in your bank account, we'll say, right now, and you're deferring that. But I am yet to meet the person who gets the retirement age and says, God, I wish I'd have spent that when I was younger. There's only benefits of doing that. But I do see the mental block of, it feels like for some people it's a long way away. You will be grateful you've done it.
Okay. And the other one is, you obviously have to commit a lot to a pension, do you, John? £500,000 a month to do it?
Not necessarily. So it all depends on your circumstances. So certainly from a business viewpoint, kind of from you coming in from a tax planning point of view, the business is the most important thing. Forget about kind of when you retire or what it looks like or anything like that. My job is to take money off people, look after it and grow for them, and give them it back. If that vehicle to take money off people is their company that they run on a daily basis, we can't stretch people and say, listen, kind of, you really need to prioritize pension planning. You need to prioritize running your business. The more successful that business is, naturally, the more money you will gain, and naturally, the more money you'll give back. So the most common question I'm asked is, how much should I be putting in? How much should I retire with? How much will I spend once I retire? And the honest answer is, for everybody, how long is a piece of string? Because there's various different things that kind of different for everybody. And it might be to do with kind of your partner's income. It might be to do with inheritance. It might be to do with kind of how fastly you can pay off your mortgage, what credit agreements you've got. It might be to do with what kind of lifestyle you want to lead, how long you want to work for. Do you want to retire early, or do you really think that kind of, actually, I want to work into late 60s, so I love doing what I'm doing? Again, on a daily basis, I probably mess about with figures with clients just on compound interest calculators and drawdown calculators, and show the difference of putting in £100 a month more or working that little bit extra. So all I would say is, with that, again, the more you can put in, the better. Fantastic. But even if it's little and often, that will have a big effect down the line, especially if you are kind of the younger working age.
And what is the minimum amount we can put into a pension?
So my firm start off with £250. So for a self-employed person, that was a sole trader, that will be the equivalent of £200 a month. And what we do is we get the tax back from the HMRC. So £200 that you give grosses up to £250. So straight away, if we look at the benefits of pensions, if you had a magic machine in the corner of your room where if you put £200 in and it spat out £250, you'd probably stand there putting kind of as many £200 in as you can. That's essentially kind of what a pension does for you. It gives you your tax back. Obviously, kind of what we're doing is we're deferring that for a little bit of a later date. For a limited company owner, again, that £250, it's at your side where you see probably the tax magic working, and it's bringing down that corporation tax bill, and you're extracting it without the dividend payments as well. So there's just little bits all over the place where we're seeing the benefits.
Okay, great. Let's divert from pensions for a second and talk a bit about sort of protection insurance. We're talking about things like critical illness, life cover policies, key man cover. There's lots of these protection policies out there. I think life cover, a lot of people understand that as a thing. Quite often clients say to me, I'll be fine. I don't need life cover. Nothing will ever happen to me. Or, it's very expensive to have life cover. So I don't think I'm going to do it. What are your views on that?
My view is that I often think I'm 40 this year. I've had a very easy life so far because I look at statistics and I believe the latest statistic is 1 in 2 people are affected from somebody extremely close to them, whether it be husband, wife, brother, sister, mother, father, affected by cancer. Now, I've lived a life where I think I haven't actually had that effect of us yet. Kind of, is it round the corner? And sometimes that's a bit of a kind of a wake-up call to me. I've got life insurance because I've got a wife and 2 kids. The first thing I protected was if I do die or if I do get some kind of horrible illness, will my mortgage be paid off on my property? Because if I do disappear, the worst does happen, I want to make sure that they're left with a roof over their head. But I've also got an income that I bring into the household as well. So it might be income protection that I have in place to make sure that kind of, should I fall ill, I can't go to work and can't generate an income, can I still put food on the table? But yeah, it's a very easy thing to think it'll never happen to me. When I sit down and talk to people about life insurance, it tends to fall into kind of 2 main camps. People who have been affected, and it might be a relative, a friend, had somebody who's come just this week, an existing client whose friend has out of the blue got a horrible illness, and he says it's made us realize I need to up my critical illness cover as part of my package, and that was down to a reactive sense. So it does happen. Hopefully it'll never happen to you. If you pay for an insurance and you never use it, you've won because you're fit and healthy, kind of you lived a happy life, fantastic. If it does end up paying out, kind of you'll probably be extremely grateful because in a time of turmoil, financially you won't have to be as worried about that aspect of it. The real heartache comes, I suppose, if you live a certain lifestyle, you're not protected, something goes horribly wrong, and not only kind of have you got that emotional aspect of it and potentially losing a loved one or seeing them suffering from an illness, financially you're also having to cope with that side as well. The protection side is where every financial advisor is supposed to start off. It's supposed to be, how can we protect what you've got? It doesn't always work out like that because introductions might come for different reasons in different ways, but it's really important that we protect what we have got.
So clients who've already got life cover, for example, or critical illness in place, it's been set up for 10 years and they've been paying into that policy. Does that need reviewing, or will it be fine until the end of time?
No, it needs reviewing. So the one thing I find myself saying to clients a lot, so the company I plug into, St. James's Place, they have a suite of insurers that we're allowed to use. So they've done the due diligence. So it's the ones that most people probably will have heard of: Aviva, Royal London, Scottish Widows, L&G, people like that. None of the kind of cheap and cheerful ones that you get advertised on daytime television. So the one thing you'll never hear me saying is, let's review that to see if we can get it cheaper, because the vast likelihood is it will only get dearer. The reason it'll get dearer is because every day we're all a day closer to dying. Brutal as it is, that's the truth. Every time we go to the doctor, there's something on our medical report says John's kind of came in with an ailment or illness. It makes us a bigger risk to insurers. So when we do that review, what we're certainly from my mind is, it's not a case of saying, can't see if we can get it cheaper. It's, is the gaps within that insurance? For instance, have you got £100,000 mortgage and you've took that insurance out to cover £100,000 mortgage 10 years ago, but 5 years ago, you've done equity release. And you've now got £150,000 mortgage. Because at that point, if you die, £100,000 drops in, but you've still got a £50,000 gap. And that's the thing that I at least need to be making people aware of and educating them about. And even if it doesn't lead down to taking out additional cover, it's being my job really is kind of what hurdles will potentially come up in the future, rather than looking backwards and saying, how can we fix that? It's how can we overcome things that might happen?
Okay, that's interesting to know. And I mean, there's one other type of insurance that I've come across in the past. It's called key man cover. What situation would you take out key man cover?
I'll use probably a situation close to me at the minute. So Northern Spire has an owner, Mr. David Cook, and he has been around for the longest out of us all, and make no bones about it, he brings in the kind of the most income into the business. We've got 10 staff about, and kind of their wages need paying. If David disappeared tomorrow, there would be a gap to fill that the rest of us would have to step up and do. So he is a key man within the business. What key man will do is it will make sure that there's a cash lump sum injection if David disappeared. That would make sure that, I don't know, staff could get paid. We might need to employ somebody else to fulfill his role, and for various reasons. But essentially, and if David disappeared tomorrow, there would be a massive element of income missing in the business. What's really important, key man, is it's not necessarily about David Cook and kind of him as a person. It's about making sure that business is sustainable. And if somebody disappears, it's still here tomorrow in 5 years, in 10 years' time, even if there's been a kind of a major incident, shall we say.
And I presume, you know, if you've got a business partner and that person unfortunately died, for example, you could, obviously the wife or husband would inherit the shares. I presume that key man cover could be used to buy out the shares. So wife or husband would get a cash lump sum from the business, and you wouldn't end up with a shareholder or business partner that you didn't know. I presume that would work fine, would it?
That could be an element of it, but there's another type of protection in there, which we look at for kind of, say, company owners who've got multiple owners, shareholder protection. So does exactly the same thing, kind of envisages if one person disappears, dies early. So essentially, if me and you, Justin, if we were in business together and I died, my wife would essentially inherit my shares. She cannot replicate what I do because she's good at what she does, but she's not a financial advisor. She's not an accountant. So she'd come in and potentially she might take a wage from the company because she needs to replicate what I was bringing in, but she wouldn't offer any value or service. From a purely business point of view, kind of you're sitting there and thinking, well, I need to run this business in the right way. So what would work for both people or both parties in that instance is if we had key man insurance, let's say the business is worth £1 million, £500,000 each. We had, shareholder protection insurance. That insurance pays out on my death. You can say, right, my wife, Kate, there's John's half of the business, and if I will now run it myself, she's happy because she can step away. She has got no responsibility for that anymore. You're happy because the business can continue in that sense. And again, kind of there's two elements to that. There's a bit of a human element where I want to make sure that if this imaginary business that me and you run together, that my wife sees the benefit of it if I do disappear. But there's also kind of the business sense from yourself to make sure that business is here tomorrow, even if I am not here, without another third party at the table.
Okay, that's very interesting. I mean, it sounds like, you know, that you've got a whole suite of products and things that you can help to stabilize and protect people. And it was a very interesting comment that you made about education. You know, you need to educate people about it. I mean, do you think that's a problem, that people don't understand this stuff?
Yeah, so it's a big bugbear of mine. So I often find myself saying kind of, I really think my job is, can I break down all the kind of the waffle that goes on around pensions and insurance and investments and what have you? Can I break it down and say it simply to the person who I'm talking to so that they understand? I personally believe I do that pretty well, but then I go back to thinking about, I can't say 100% with education systems right now, but when I was at school, I was never taught about mortgages. I was never taught that I would get taxed when I when I got a job. I was never taught that national insurance is important because that goes towards your state pension. Go back to mortgages, you need to save a deposit to get a mortgage. I was never taught about really kind of interest rates. I would like to see from an early age, or certainly kind of from the point of getting 16 to 18, when people are entering the adult world, I would like to see them being educated a bit more about it. I am 100% a person who started to stumble through life because I wasn't always a financial advisor. I worked in a bank before this. I bought my first house before I worked in a bank and did my mortgage. I got took through by a mortgage broker who was excellent. And he says at the end, right, what about your life insurance? And I went, what about that? And he says, girlfriend at the time, not wife, can she afford to pay the mortgage if you die? And I went, no. And he went, well, that's why you need life insurance. That was an example of me stumbling through life and learning as I go. And I ended up in a kind of an area where I can help educate people about this. go back to right at the start of the conversation, the majority of your clients probably will be financial advisors. They'll be excellent in what they do, but they won't have a working knowledge of maybe kind of what I do. So it's about passing that on and kind of educating, really.
Okay, that's really interesting. I think what I'll probably do is wrap it up there, if that's okay, John. I think there's been some really useful stuff come out the back of that, really interesting insight into the world of pensions. I think protection policies, consolidating all of those little pension pots. I know, because I've known you for several years now, John, that you've got a similar value system. You're all about education, and you're someone who I trust with my most important asset, which is my clients. Which I don't take that sort of. I'm very careful about who I choose to work with, and you're very much on the same values to us as an organisation. For anyone who's watching this on the e-learning platform, I'll put John's contact details down there as well, so you can reach out to John. He's always happy just to have a chat with people. I would say that's right, isn't it, John? And then we can go from there. Yeah,
of course. Always happy to talk. My time costs nothing.
Well, thanks very much, John. And again, many thanks for sharing all of that.
Thank you for inviting me.
Cheers.